Oh boy, is it a good episode today. The RBA has just come out and increased the cash rate for the first time in over 11 years. This is going to cause mass panic. You can already see what the headlines will be, that the market's going to come crashing down. But I'm here to absolutely break this down for you, and so that you can walk away understanding what's about to happen, what we can see in the market, and why has the RBA decided to do this. If you're interested, keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, cryptocurrency, and financial freedom. Now, occasionally I'll make a video about something that is so drastic that will cause all headlines tomorrow morning to read that the market is about to crash because of the interest rates. Now, if you aren't aware, the RBA has come out and increased the cash rate by 0.25 basis points, which is basically 0.25%. on top of what was already the cash rate at 0.1%. Now, why is that such a big difference? Why is this such big news? And why am I making a video about this? Well, apart from the fact that I like researching and doing nerdy things, I think it's very important for us to understand when looking at Australian real estate, looking at asset prices, and looking at potential recession fears, we need to look at what the central bank here in Australia is actually doing. Now, in this case, the RBA increased for the first time in over 11 years. This is a big move. And I know that for a lot of people that haven't been through this, me included, haven't been through the last increase in cash rate, we have seen banks already been increasing their bank interest rates, which is effectively what affects us as we go in to pay our home loans and the interest we pay on that mortgage debt. So is there a logical reason why we've seen an increase in the RBA's cash rate? Yeah, there is, because inflation came in higher than we ever thought. We want to see 2 to 3% as our CPI. However, what we've seen is 5.1%, and this is no surprise. We've been talking about this for like 2 years on the channel, and we know exactly why we have so much inflation in the system.
It was, cheap money.
So we have CPI above 5% and we have unemployment which is below 4%. So it seems like a very healthy economy. We're expanding at a rapid pace and at a pace that most people are now scared, because if it goes too quickly, we have mass levels of inflation, and that is a problem for the entire economy. So the anticipation of an increase in interest rates has actually caused the markets to react for the last few months. And I feel like the reaction in the lead up to this anticipated fear is actually going to be worse than it actually is. What we've seen is the worst start to a year for the S&P 500, which is the share market, in over 83 years. So it's been crazy, and all on the back of the fear that we've grown so quickly, we've had so much money into the system that now we need to control inflation, which means the government's going to step in with their friends, the central bank, and they're going to start reducing and contracting the economy. That means less money to go into things like the share market. The money markets are in meltdown at the moment, and we believe the next part to this entire piece of the puzzle is housing. Housing needs to calm down because interest rates went up. Everyone's scared because the entire economy is growing too quickly. But when it comes to real estate, we need to take into account this is just one factor: the cost of borrowing. Now, yes, an increase of $100 or $200 a month definitely does affect people's behavior. However, when it comes to real estate, the way that you need to look at this, there are multiple factors that affect that real estate that you're actually about to buy. I'll explain that in a little bit. Now, straight after you think about the interest rates rising, you think about how high can it rise and how quickly can it do that. And this is where I think we need to take a step back and look at this logically. And the easiest way to explain this is going to be to understand that if a mass majority of people, businesses included, people investing into their homes and buying their own homes, they go out and they take debt at say 2%. And that's been the majority of the case over the last say 18 to 24 months. So if you go and borrow at 2% and then you see an increase in that interest rate to say 4%, you now have some people that are underwater. This starts causing cracks within the housing market, but it goes beyond that. It goes to companies, it goes to how they employ people, and it could actually lead to more inflation. Because if a company has to increase its costs because of the borrowed money that they have, they need to then offset that because we have wage growth increasing. Then you have a play where they're just going to pass that cost on to customers, which effectively means the customer's paying for more goods every single day, which again plays into that whole inflation narrative. Now, here's a graph that I've got on here, and it's for housing loan commitments, excluding refinancing. So it's just basically all new borrowing, and it's based on investors, owner occupiers, and what the total looks like. You can see a dramatic increase ever since they started reducing those interest rates. Now, the cash rate that the RBA controls, we were at 0.1%, which is an emergency level. We had to do that because you shut down the entire economy. The whole world was at a standstill. So you needed emergency protocols for that. Now, people are arguing,
Well, we're not in emergency state anymore. In fact, we're probably going the other way.
well, we need to increase these interest rates and slow and contract the economy down as quickly as possible. Otherwise, we spin out and the currency gets so devalued that it just doesn't make sense to save anymore. Now think about this. If you have investors that go out there, purchase property, and they've seen my channel and they've gone out and purchased good real estate, they probably have a really good, healthy cash flow position. Meaning that if interest rates do rise, you're in a good location, that means the rental demand is there, that should increase your rents as well. And that's what we've already seen amongst all of our clients, including my own portfolio. So the difference between my mortgage rate going up and then the increase in rents means that it sort of offsets each other. But what we do have is a bunch of people that have bought their own homes, owner occupiers. And I've said this in numerous videos. You can check this one out. It's a deep dive into this topic, and it's around why I think that if we do have a correction in this market, it will be from top down, which means effectively the emotional buyers first, then it comes down to the logical buyers. The emotional buyers are usually spending more than their means, and they're buying something they truly, truly love because,
Hey, who doesn't love another kitchen and the extra bedroom? Of course you need 6 bedrooms.
so if it follows what some economists are saying, and they're suggesting that the cash rate is going to go up by 10x, basically saying they're going to go to 2 to 3%, this could put a huge amount of pressure onto the economy, and because it affects the first home buyers. The government incentives that have been put in place to encourage these people are now getting screwed over because the debt they took on is something they can't afford. Now, if this does go on to affect housing prices and we have this massive crash or correction, who do you think folds first? Is it the emotional buyers that have no emergency funds, that are out there buying something that they truly love because they want to live in it? Or the people that have investments that have been in there with LVR positions below 50, 60%? Because don't forget, a majority of the real estate in Australia is either paid off or has a really low LVR position. It's more of the newer loans over the last 5 or 10 years that have been taken up that have the higher percentage LVRs, but we're already seeing that reduce. Now you might be sitting there and thinking, how the hell did we get in this position? Like 2 years ago, we're in a recession, and now we're in a position where we need to increase rates because we're out of control, expanding too quickly. What is happening? And it was a very deliberate strategy that the government came in. It was basically like,
You stay at home, I'll pay you to stay at home because we need to control this virus.
and this meant they opened up the taps for lending because everyone had more money. They went out and invested their money into assets like real estate. That took off along with the household debt that was attached to it. And we found ourselves in a position where people were spending a lot more because of the wealth effect. I've spoken about this on the channel before as well. People feel like they're more wealthier because the prices of their assets have increased. So this has a positive impact on the economy. Now what we're going to see is the opposite. If we start seeing that property prices are starting to decline, and we've already started seeing it in Sydney and Melbourne, is that if we start seeing that, we could have the opposite reaction. We could have people go,
Well, I don't want to spend any more money at the restaurant and the cafe, and I want to save that money in case we go into a recession.
now the problem here is that the RBA is in between a rock and a hard place. If you increase rates too quickly, the whole economy implodes. You don't do anything about the cash rate, and you continue kicking the can down the road before we have a massive correction. Falling prices across assets makes people nervous. We've already seen that in the share market. People want to buy high, sell low. That's just the game. But in fact, we want to do the opposite. Real estate is no different. But what I've got here is a graph that you really need to pay attention to. You've got the red line, which is basically home loan interest rates, and that's been trending slowly down. You've got the blue line, which is inverse to that, and that's basically trending up. Now, the biggest takeaway from this is not so much the direction in which they're going. I mean, that's important. But what's important is every time the interest rate has increased, it's tried to create a higher low, but it hasn't been able to do that. It has been trending down, much like the crypto that you're holding because you got told that shitcoin was going to go to the moon. You can see this at numerous times, and this is not just data from like the last 10 years, this is over 30 years of data. And you can see the increase in 1992, the increase in 1998, then the increase in 2007, and then finally the increase in 2010, which is pretty much 11 to 12 years ago when we had that last increase. So what can we gather from this? We know that there's going to be ups and downs in the cycle, whatever cycle you look at, but the trend has always remained the same. What I think personally could play out is we have a slowdown in the economy. This may affect some of those larger emotional markets, but some other regions that are really affected by the rental crisis may start seeing a huge amount of cash flow come in, which will provide boost to investors to hold their properties during difficult times. What we could see is a slowdown in growth, but I don't see a massive crash or correction happening in some of these markets. Now, I'm generalizing here. There are going to be properties that fall, and we just need to know that if we are investing, we've taken the right opportunities as well as looked at the right data, matched that up with consumer behavior, and we've got ourselves a really nice cake to eat. So what are your thoughts on the RBA increasing interest rates? Do you like them? Do you think they should go higher? In my opinion, we're trying to address a problem with inflation, but with a tool that probably won't work. And I'll tell you why. There's stuff that's out of our control that's still gonna push inflation higher. The biggest is the supply chain issue, which is causing the cost of goods as well as things like building supplies to go higher. We have an extreme shortage of real estate in Australia, and we have the introduction of more immigration into the country. We have ourselves the recipe for what I would say is going to be the second leg of this next bull run. Now, I'm sure the comments are going to disagree with me, but I believe here truly that we're going to see a complex situation play out where most people are scared, but the select few are going to pick good real estate, good assets, and they're going to continue to DCA in, just like I am in this market. I would love to know what your thoughts are. Are you buying? Are you holding? Do you think the market's going to crash? Let me know in the comments down below. If you're new here, definitely smash that subscribe button. And if you need more alpha and you want to talk more about this nerdy stuff, then definitely join me in Patreon. There's a link in the description below. I'll catch you guys in the next one. Thanks, guys.